Well, Happy New Year, everyone, and welcome to our first video of 2023. Dion Zukiwsky, Branch Manager and Portfolio Manager here with you. And given the new calendar, we're going to have a quick review of what happened last year. We're going to dust off the old crystal ball and see what's coming. And we're going to also have a segment that I like to call Reality Check. Plus, we're going to bring in rockstar associate Jewell, who's going to have a Did You Know segment focusing on tax-free savings accounts and RSPs. So from an investing standpoint, is anyone else out there happy that 2022 is over? Absolutely. It was not an easy climate to navigate, with interest rates cranking up around the world due to high inflation, wars in Eastern Europe affecting everything from commodity prices to global stability, and bizarre COVID policies in places like China, all contributing to market volatility. And this volatility wasn't only felt in the stock markets, but in traditionally defensive areas like fixed income and bonds as well. It's really quite rare for both of these types of assets to pull down together, and we're going to explain more in a chart here. Along with our teams at Scotia, we looked at returns of equities or stocks and bonds in a combined portfolio going all the way back to World War II. We used the US as there is more historical data available. And in a very traditional and basic setup of 60% market, 40% bond mix, only one other year has had both asset classes in the negative, as shown by the red circle. Most years has this portfolio moving upwards together, which is the upper right quadrant. And in years when stock markets underperform, then bonds are usually up and help to provide that cushion, which is needed, and that's also shown in the upper left. So a tough year indeed. In our Zukiwsky Group models, we did have some good performance in the alternatives category, which is our pension fund investments in areas like real estate and private equity. We also saw some gains in a few of our energy positions, such as pipelines. Well, now that we're in January, it's time to bring out that old crystal ball and decipher what's ahead for us as investors in 2023. One of our most challenging tasks is to filter through the incredible amount of research that's thrown at us and come to a conclusion on what makes sense and, of course, what's suitable for investors moving forward. In review of all this, there is a few key themes sticking out. First, there's a shift of focus from inflation concerns to now recession concerns. With the big move in interest rates, and probably a couple more coming in early 2023, inflation is starting to get under control. However, we are seeing the ripple effect go through the economy, and it's predicted there will be a mild recession, which may knock around investment markets a little while longer. The more positive news is that it is also expected that interest rates will not have to rise forever, and should pause in roughly the first half of 2023. As the picture becomes more clear, we expect markets to recover and begin their upward cycle again. Since markets are always looking forward, many times that upward path can begin even though the economy itself is still technically in recession mode. A final thought is that history is on our side regarding performance. As I mentioned earlier, it's very rare to see both equities and bonds pull back together. Also, anytime the US stock market has had a down year, there is about an 80% chance of a positive year coming forward. How's that for crystal ball action? Our overall strategy is to stay defensive for the time being, and then look to add growth as the picture becomes more clear. It's likely we'll see some bumps in the early part of 2023, but we are more optimistic for returns in the second half of the year. Holding high quality investments and providing close monitoring will be the plan for now. So far, we've reviewed what happened last year and what we feel is coming up next. But what really matters most? This is where we feel taking a step back can be really important. First is to review why you are invested in the first place. What truly are the goals that these funds are for? And what are the time frames that they're attached to? By doing a check-in with your wealth plan, it reminds us on what is most important in helping to tie your financial life to your real life. If you do not have a wealth plan or feel that you may need an update, please contact our team. It's a big part of our job for you. The second reality check is that time is on your side. As it relates to goals, we do not necessarily need to focus on what happens day to day, week to week, month to month, or even year over year. That is because, like the general economy, investment growth always does occur over the long term. Let's look at an example here. So if we measured the largest market's return over the last 3 years, a $100 investment would have had its ups and downs and given you a return of about $20, or a basic average of 6.5%. Note that in 2022, we saw an actual decrease from the year before. But what about a longer term approach? Instead of 3 years, what if we take that trend out over 30 years? What does that look like? Let's check this out. You can see there is a big difference and a smoother line, and the trend is definitely from the lower left to upper right. In fact, that same $100 investment since the early 90s would now be giving you over $1,500. That's a return of 14 to 15 times your investment. And a final reminder on the basics is the value of advice. Our job is to partner with you to develop that wealth plan, recommend a suitable mix of investments that match those goals, and of course, help you navigate through any types of choppy waters. Also included is to help to decide what types of investment accounts are the right mix to maximize savings and of course, reduce tax where possible. For example, how to properly use RSPs and tax-free savings accounts. To learn more on this, we're going to bring in Bond, who's going to have a Did You Know segment to explain further.
Do you know the difference between a tax-free account and a registered savings plan, otherwise known as an RSP? We often get the question of whether it's better to contribute to your tax-free account or to your RSP. And the answer is that it depends. Let's look at some of the benefits and features of both. So for contributions made to a tax-free account, there's no tax deduction received for that. However, there is for an RSP. For 2023, you can contribute up to $6,500 to your tax-free account. Cumulative is $88,000 if you've never had one before. For RSPs, it's based on your previous year's income, which is 18%, to a maximum of $29,210, plus any unused RSP contribution room from before. For RSPs, they have to be turned to what's called a RIF account at age 71, so at that point, contributions have to end. For tax-free accounts, at this time, you can go on indefinitely. Now, withdrawals from a tax-free account, of course, they're tax-free to you, and you can contribute whatever you withdrew 1 year, you have to wait a calendar year, and then it can be recontributed. Withdrawals from an RSP, you did get the tax deduction when it went in, so when it comes out, it gets taxed to you as income. But both RSPs and tax-free accounts allow for tax-free growth, which over time can be very powerful. So which is better? It still depends. If we work together and put together a wealth plan for you, that can definitely add some clarity to around which is the best route to go. Now, income can be covered quite often from your RSPs and other pensions. When it comes to incidentals like home renos, vehicle replacements, maybe vacations in there as well, that can come from the tax-free account. Tax-free accounts, because of their tax-free growth, are also an excellent way to maximize your estate for your beneficiaries. If you'd like to contribute to your RSP or tax-free account, there's a few ways to do it. One is if you bank with Scotiabank, using Scotia Online and not the mobile app, you can simply transfer between accounts as you would between savings and checkings account. If you bank with another financial institute, Scotia McLeod can be set up as a bill payee. Please note that it's Scotia McLeod, and then you use your 10-digit TFSA or RSP contribution, and you can do it that way. Of course, you can always give us a call and we can transfer between accounts as well. If you'd like to complete or update your wealth plan, please give us a call. Always happy to help and to answer any questions that come up. So that's it today. Thanks for watching.